Good afternoon and welcome to the SMARTSPACE Software PLC Final Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to CEO Frank Beechner. Good afternoon, sir.
Good afternoon. Hi everybody, I'm Frank Beechner. This is Chris Shaw. We're here to take you through our full year results at the end of January this year. We're actually coming to you from the Canaccord offices today, just in case anyone thinks we've gone mad and spent all our money in the flash new office. So we look forward to spending a bit of time with you this morning and giving you an update on the business.
Morning, afternoon everybody. So first of all, just on the financial highlights, just to point out that we have now classed the A&K business as a discontinued operation. So all of our highlight numbers here, which we've got here and in our financial statements, don't include any impact from A&K. So the revenue and the cost for A&K have been stripped out into a discontinued line. And that goes down all the way down through the P&L, down to the ARR numbers, and the balance sheet has also got the assets and liabilities of that disposal group classed as a assets and liabilities held for sale. So the group revenues for the year were up 48% to just over £5 million. That increase comes from a combination of things. So we've got the new customers who sign up for the product during the year. We have expansion from our existing clients, so customers who move up through the price bands from the starters to the business and the enterprise. We have customers who take up new locations, so they might join us with one location and add additional locations on during the year. And also finally, we have a price increase, which we started about 2 years ago, but it takes time for it to feed through to our revenue, as customers only pay for that price increase when they get to their next annual renewal. The vast majority of our revenues are now recurring revenues, now that we've removed the A&K element from there. So our recurring revenues make up 97% of our revenue. The remaining 3% is the contribution which we get from the Evoco panel sales, where we get a one-off license fee for each panel which has been sold. And we also get a small amount of hardware revenue within the Swipe Down business as it sells iPads to some of its customers. But as I said, the majority of our revenues are now recurring revenues. The ARR, the annual recurring revenue in the year, grew by 25% to just under £5.6 million. That increase of 25% is made up of a combination of new customers, probably about half of that is new customers. It's expansion from existing customers, probably another 20% from that, and then it's the price increase. The way that our revenue profile works is often the increase in ARR numbers will feed through to the next year's revenue numbers, and so we'd expect that 25% increase to feed through to the following year's revenue numbers. The gross margin from the continuing operations is 89%. Again, obviously with A&K removed, we have a much higher gross margin from the software side of the business. And the direct costs which we've got in there is principally just our hosting costs for hosting the services which we provide. We might see that increase as we go forward. I would expect it may go up a little bit, even from where it is right there. The EBITDA loss was just under 800,000, obviously significantly improved from the previous year of 2.4 million loss. And that's coming really from the increase in revenue which we've got coming through there, whilst we've maintained a fairly static overhead within the business. The admin expenses increased for the business by just over 1%, and even if we adjust for the impacts of any capitalised development and things like that, then again the admin expenses were only up by 3%. And we're very much focused on making sure that we are tighten our admin expenses and making sure that where we spend money, we see some value in return for that in terms of increasing revenue, in terms of growing the business. The cash balance at the end of January was just under £2 million. That's it. The gross cash balance, and the net cash position was £1.6 million. we had a mortgage on our freehold building in Mildenhall, which is where A&K is based, of £330,000. We actually repaid that mortgage just after the year end in February. The principal reason being is that, as we mentioned previously, is that we're not seeing the A&K business continue within the continuing group, and therefore we didn't feel it appropriate to renew that mortgage when we have plans to find new owners for that business. The graphs here again just show the growth in the annual recurring revenue, and that feeding through to the actual recognised revenue on our income statement. Very much focused on making sure that we continue this growth in the business and growing those recurring revenues, whilst also obviously maintaining a steady cost base within the business. Obviously, there will be impacts of inflation going forward, but we don't see a big increase in overheads needed for the business going forwards.
In terms of where we go from here, really, we're focused very much on growing a pure play software business, where the majority of our revenues, as Chris mentioned earlier, are contracted recurring revenues. Obviously, our margin, as Chris mentioned, is much higher in the pure software business, and we're at a point in our software business now where we don't need to take on much extra cost to see continued growth in terms of new customers. 75% of our customers pay annually in advance, so we've got strong cash flows from the existing business, and we've also got a very robust LTV to cost of acquisition ratio of 5:1. So that shows really that our marketing campaigns are working. The marketing team based down in New Zealand do a fantastic job. We moved our Google AdWords campaign management back in-house last year. We used to use a third-party agency, and we had a great relationship with them. It was there for 3 or 4 years, but we got to a point where we felt we could do a better job ourselves, and under the stewardship of the marketing team there, we have actually shown that, and we're getting a better return. We're seeing a reduced cost per click on the advertising, and we're getting very good quality leads coming through, which ultimately feed our new customer growth every month. We operate in Swipe Down. About 97% of our business is actually direct, so we sell to the end user. In Space Connect, it's 100% is through channel. Now, as we move forward, we'll see a sort of blending of both those sides of the business, where we actually look at new partners to carry the Swipe Down product range, and in particular Spaces, which we'll talk about in just a second. So again, we're on multiple channels in terms of routes to market. We've seen a downward trend in churn over the last year, and that's the number we're showing here is annualized over the year, but month on month churn is reducing. A lot of that is down to the fact we're coming out of the COVID period, and people who felt compelled to use some of our technology purely to enforce COVID regulations, they've sort of now left us. Whereas now people are buying our product because we're a strategic part of their decision to optimize how they use their real estate, either at the front desk or in desks within the business. Our optimum customer is a multi-location customer, and a few years ago we averaged about 1.1 locations per customer. Now it's currently at 1.8, up from 1.5 last year, and we've got 8,377 locations using our products across the globe. Our big effort in the last year in terms of software development has been around Spaces. Now, a few years ago we had 3 options. We had 2 software stacks, Space Connect and Swipe Down. We could actually center everything on Swipe Down and make sure we get all the functionality from both products, plus what we felt that customers were looking for, into a whole new platform. We could have centered it around Space Connect, or we could have built something completely new. In the end, we decided we want to build everything around Swipe Down. The guys in the development team have done an incredible job at building out really good base functionality within that platform. So it's multi-country enabled, it's multi-currency enabled. We allow people to host in different regions across the globe now, which the customer selects. And then we also have the ability to self-provision, take credit cards. So there's a whole lot of things in the Swipe Down platform that we just didn't have in the Space Connect platform. The development of Spaces has been ongoing since this time last year. We've aimed to have it in the market by August of this year. The progress on it is going really well, and we're looking forward to that now as driving our sort of sales activity next year. For the remainder of this year and into next year, that is. And a target audience for us is the 4,800 customers that we have already using our VMS solutions to go and offer them Spaces. And with the intention with Spaces to be able to offer them desk booking, car park space booking, EV charging point booking, bicycle space booking, locker booking. So any asset that's in short supply within the business that an employee may wish to use for a defined period, Spaces will allow you to actually make that available to book and for employees to actually activate a booking from their app. We've seen growth from existing customers. And we did get the benefit of a bump on the price increase last year, which is why there's a slight differential. But the important thing is that we're actually growing the existing base now. We've got some new modules coming out. We've got one that's imminent, which is inductions, which allows customers on the visitor system to go through a sort of pre-programmed induction process before they're given a visitor pass to come into the building. And we hope to have that in the market in the next few months. On the market development side, we launched last year in Korea, and we selected Korea because we felt there was a good market there. But more importantly, is because it was actually quite challenging in terms of language. It didn't use Google as its main AdWords engine. We wanted to stress test ourselves to see, could we actually take our product, completely localize it, create the marketing machinery around it to attract new customers, and then get them converted into paying customers. We learned enough out of that process and have the confidence that earlier this year we decided to press on with three geographies: Taiwan, China, and Germany. And it's early days in each case, but we're seeing good indications. Originally, we had put aside a notional budget in our minds of how much we want to spend in each market. The work that we're putting in so far shows that investment is coming in a lot lower than we'd originally expected. And more importantly, that the scalability we felt was there last year is definitely there. We've proven it out in practice. And when we go into a new country now, we can do that with very little, if not no involvement from the development team, because the guys have been able to, as I said, create a cookie-cutter approach to going into a new geography, and it becomes predominantly a marketing exercise at that point. As I said, Germany's off to a good start. In Taiwan, we've slightly different models in each market. In Taiwan, we're using someone who works directly for us as the main point of contact. We haven't set up an office, and they're not a full-time employee. In Germany, we're working through a third party. And again, you go to the swipedown.de now, you see a fully German website. If you download a trial, the product is fully localized in German. The demos are conducted in German, and any inquiries, and then the close to sales. So initial indications are very positive. And as I said earlier, the cost of going into these markets is actually quite low. And the fact that we can do it really reasonably quickly means that we've got something that's very scalable. We've no immediate plans to go into other markets, but once we can see that these are delivering to the KPIs we've set ourselves, then the potential to expand into other markets quite quickly is very high. In terms of where we go from here, obviously, keep driving on with our new customer wins. We've had a good run over the last few months. The year started a little bit more slowly, but actually picked up in the following 2 months. So growing our core markets, English-speaking markets of the US, UK, Canada, Australia, New Zealand are really important to us. And obviously, keep going in non-English-speaking markets and see the Germany and Taiwan and the other markets sort of coming to fruition. We have an ongoing program of migrating customers through our plans. Our highest value plan is enterprise, and we actually generate 51% of our revenue from just 14% of our customers. So there's a clear opportunity there for us to bring people up through the various plans. The key with that, of course, is to make sure we maintain the value proposition, that people feel that they're actually getting good value. On this note, we got asked a few questions yesterday about price sensitivity, and are we seeing any are we coming under attack on price in any markets? And some markets have local vendors where they'll have a local price that's maybe lower than ours, but in the US we come up against businesses like Envoy where our price is below theirs, and we believe we got a product that's just as has as many features and resonates well with customers. Another part of our strategy is to go after multi-location organizations. So we've mentioned before, we've got people like DHL we're in about 70 locations with them now, and predominantly in the US. And we've got people like Gate Group and that. So looking for more of those types of deals. Mentioned the inductions product earlier, so that's as I say, that's imminent, and we're able to get that out into the market quite quickly. And the big push then is around spaces and the impact of spaces on our business, because the cost of acquisition is low, because we'll be targeting predominantly existing customers. It's got to be big. We see big potential to actually open up our channel. As I say, we currently operate channel from Softcat at one end right down to SaaS referral partners who get paid for a click on a link. We believe we can evolve that, and we're going to be working on that over the coming year. And we've obviously got a relationship with NASO as well. They've got some new releases coming now. They brought out a Clear product, and they've been able to integrate the booking of desks and meeting rooms actually in one app, which they're just about to release that, and we expect that to have a positive impact on our sales.
So just where we are on A&K, so we started a process to find new owners for the A&K business last year. It was a bit frustrating initially. We engaged with one party which we didn't make significant progress with, but it did take time. And at the beginning of this year, we decided to terminate those discussions because we didn't think we were making sufficient progress. We are discussing a deal with other people at the moment, and we're confident that we will be able to complete on a transaction within the foreseeable future. We have valued the A&K net assets on our balance sheet at what we consider to be the fair value of those assets less the cost that we'll have to sell them, and that's at 1.2 million. So we would hope that any transaction will be in that region if it did complete. The A&K business last year increased its revenue back to around about 2 million. Our target really was to get this business back to where it was pre-COVID, and that's pretty much where it is now, and we think that it's in a good position to be able to find new owners for that business now. Just looking where we are since the year end, so as I mentioned before, we actually repaid that mortgage that we had on that freehold building in Milden Horse. That was £330,000, which we repaid at the beginning of this financial year. The cash as of 30th of April was therefore 1.25 million. We do have a higher cost base in the first quarter of our financial year than the rest of the year, and we make payments for things like our insurance, our audit costs, and certain elements, parts of the bonus payments go out at the beginning of the financial year. And so that's why it has reduced our cash balance at the beginning of the year, and that's totally what we were expecting and planning for the year. And we would expect it to start to increase from this point onwards. We're forecasting this year to be, targeting this year to be a cash flow break-even year, with a break-even EBITDA as well. We added new ARR in the first quarter of the year, just under 200,000. The first month of this financial year wasn't as strong as the second and third months, but we certainly expect things to continue to grow through it for the rest of the year as well.
Just some commentary on general market conditions. Again, a number of questions we were asked during the course of the day. Yesterday was, there's a definite feeling out in the market that businesses are stalling on major investments. We're not feeling that. We were quite worried in the autumn of last year, especially around the UK, where sentiment was quite bearish. What we're seeing, and in the last few months reflected, is that our sales momentum has maintained. We think that's down mainly to the fact that the amount of money that people have to invest to use our product is relatively small, and it tends to be much further up the price point scale that those businesses get stalled. So from our perspective, really, we're good traction in the US. good traction in the UK, and equally down in Australia, New Zealand. There was a bit of a stall in Australia sort of earlier this year, but it seems to be picking back up again. Again, for those of you who have been on previous presentations, we've sort of had this slide and we just sort of keep it updated. Basically, the M&A activity amount in the market has continued at pace. The last comparator sort of acquisition for us probably was ProNester by SignInApp, which took place late last year, but they've since gone on and bought 2 other businesses. And then Thoma Bravo, who own Condeco, one of our big, and ProxyClick, 2 of our big competitors in Europe. They've brought all of their acquisitions together under one brand called Earth2. So there's definitely a lot of activity in the market, and the fact that there's 4 or 5 significant consolidators keen to grow the market, I think is very encouraging, and people are in this market because they feel there's a lot of opportunity to grow, and it's sort of reflected in what we're seeing on the ground from our customers. So just to bring it to a close then, before we go on to the Q&A, from our side, new geographic markets and the new product offering are critical, as we described. We want to, in saying all of that, to us, there's 3 areas of value that we can drive in the business. We've got our SaaS metrics, which are really important. So we've got to show strong growth in ARPU, ARR, good CAC to LTV ratios, etc. This year, the emphasis is on making sure that our financial metrics pass muster, i.e. that we're not burning cash and we start to move through to profitability, because clearly assets in that space right now attract a lot more interest and attract much higher valuations than businesses that are loss-making. So from our perspective, really, getting the financial metrics right is critical. And the third pillar, in our view, then, are the strategic value in the business. And part of that is getting our flags in as many new markets as possible, and at the same time then evolving our development organisation and our technology, moving towards a single platform in the business as we go forward. With the fact that A&K leaving the group this year means that we are a pure play software business with the margins and the recurring revenue and the metrics that you'd expect from a business in our space. We see great demand across the globe, and definitely the growth in hybrid working has helped, because with Swipe Down you can check in from home as in the office and things like that. There's a definite sense that there's fewer desks when people do get to the office, and you could potentially use it, manage it on a spreadsheet, but applications like ours make that whole process of booking and reserving a desk and allocating desks so much easier for everyone. So all in all, really, we're excited for the future, and it hasn't been an easy few years for many people in our markets, and we can see a great opportunity in our core markets and then growing outside, and we've got the cash to execute on those plans. So thank you very much for listening in this morning, and we'll switch across to the Q&A in a second.
Frank, Christian, thank you very much for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation, and thank you to all investors for submitting their questions. Could I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
So we've got one here. Would you expect A&K to be sold by time of interim results? And are there multiple parties who might be interested? We're obviously limited as to what we can say about any discussions, but our intention would be to have a deal concluded by the interim results.
Yeah, fair enough? Yeah, no, 100% agree. Yeah. Mm-hmm. So question here, can you give a breakdown of other admin expenses entry within the admin expenses summary in yesterday's results statement? I did actually have a look at this today. Actually, it looks like a number has dropped off in the comparative period, so it's been hidden by the borders. So it looks like the increase has gone from 99 to 1 million. Touching it's gone from 997,000 to 1 million. So it's not a significant increase. So the actual what is in there is the cost of running the business, such as our audit costs, our insurance costs, and other similar things to that in terms of actually just running the business. So I think there's some hosting costs in there as well. Any establishment costs that we have within the business, so office costs and things like that. But it isn't a significant increase in comparison to the previous year. It's just that number has been hidden by the borders in that table, unfortunately. So that will be updated.
The joint swiped on Space Connect platform, does this increase cross-sell opportunities or reduce costs, or both? Because we run very tight on costs anyway, there's probably not a great deal of cost reduction. So it's not like we're taking two teams of 40 developers and bringing them into one, and you'd actually lose 20 heads in the meantime. There may be some economies, but generally what we've done is sort of move people around from one team to the other. So we're not expecting great cost reductions, but equally at the same time our cost base is low anyway, and we're not expecting big increases in that base going forward. Definitely an increase. We see an increase for cross-sell opportunities. Space Connect right now, it offers visitor management, but it doesn't do it as well as Swipe Down. It's got desk management and it's got meeting room management. Spaces brings in desk management, and it'll bring in parking spaces, EV charging points, and indeed any bookable asset really. So that it does create much broader cross-sell opportunities. And in the past, if you were in Swipe Down and you didn't want a visitor system, we really didn't engage with you on much else, maybe desks over time. But whereas now we'll end up with a number of entry points with a new customer, and a lot of opportunities to cross-sell to existing customers. So yes, very much we see it as a big cross-sell opportunity going forward. The beauty of it, if you're an existing Swipe Down customer, is that you will log on one day, sometime in August, and all this functionality will be there. We don't need to send you anything. We don't need to update you anything. It'll be in your control panel. And if you said, look, I want to start using 50 desks on Spaces, you can just upgrade your account or put your credit card details in, and it'll happen automatically. It doesn't require anyone to go on site. It doesn't require any implementation or deployment effort.
So, question here, the 3% growth in ARR since the year end is in line with location growth. Does this mean your main price increases are mostly played out? And would you expect revenue growth more in line with location growth? Where are management expectations for revenue growth for this year? So yes, the majority of the price increase which we started, it was just over 2 years ago actually now that it was started, has now been factored in now. There are still one or two, well, probably a few more than one or two, but there are still some enterprise level customers who are experiencing that price increase over a longer period of time. And so some of that will come through, but the vast majority of that price increase is now in place. And the revenue growth will come from expansion in locations, new customers, expansion from existing customers. So that's where it's going to come from this year. Revenue expectations for this year, I mean, I would just point you in the direction of the Canaccord note, which I think they have 5.9 million of revenue for this financial year.
There's a question here on the Swipe Down website. Why does it have no reference to SmartSpace software? To be honest, we hadn't noticed that. We'd upgraded the websites both recently, and Space Connect actually doesn't have a reference on there either. So we'll get that corrected. So, but more importantly, if you go to the SmartSpace PLC website, it does take you through to the individual product websites. So again, I say just an oversight on our side when we did an update, and we tend not to get many customers coming back that way anyway. And the PLC website is purely for shareholders. Can you share your roadmap plans and implementation of growth? We probably covered that in some of the slide decks, slides there. So we probably. That's probably rather than go back over that again. I think we've covered that off there. one other here, which is how does software support for the Evoco platform dovetail with your own software development plans? We don't have a dedicated Evoco team. They're basically the Space Connect software dev team, and they manage that in parallel with supporting the Space Connect product stack. In terms of actual software support, we provide third line support back into Evoco, so they provide first and second line. So their dealers will do first line, Evoco do second, and we get third. So we tend to get involved in more technical conversations, and that's delivered from a combined support team that sits in Mildenhall. So we don't have a dedicated Evoco support team. So there's a complete dovetailing. But over the last few years, we brought together development. We've now and we brought together support. And during the course of this year, we're going to get the sales of both product stacks actually working more closely together. So, and again, if we ever launched another product, we wouldn't be creating a separate development or a separate development team or a separate support team to manage that product.
Question here: what is the approximate value of the freehold property? It's in our books. We had it valued about a year and a half ago, 2 years ago, at about £670,000. It has probably gone up a bit since that point in time, but it's in that order of magnitude, I'd say.
This one here, is this business now a 10% ARR growth business now that price rises are finished, or are your ambitions a lot higher? If you're looking to sell the business, then the multiple a buyer will pay for this growth rate is a lot lower than 7 to 8, I think. Do you agree? I think the most important thing is that what we've got out in the market in terms of forecasts are what we feel are conservative. Now, they put very little emphasis on spaces, for example, and no emphasis whatsoever on new country growth or new market growth. Now, for us to go and say, well, we think we're going to do really well in Germany or Taiwan, let's go and add another few 100,000 of sales in there, would be unwise at this stage. We'd want to prove it out before we could actually, before we'd be minded even to adjust internal forecasts, let alone what's out in the market. So on that basis, you can assume that we feel there's a lot more potential that's reflected in the numbers right now. And we definitely don't want to be a 10% ARR growth business. The key to that, and we appreciate we did get a bump from the price increases. The price increases equally won't stop. I mean, there'll be others coming. The question will be one of timing and what level it'll actually happen. But more importantly, what we want to do is to, I suppose, keep that sales momentum of new customer acquisition going, and then really get going on the cross-selling through the Spaces platform, and that should get us back to a growth rate that's well in excess of I think it might be 14 or 16% that's forecasted by Canaccord now. So we want to be in excess of that, and we believe we've actually got the platform and the capability of and the money as well to actually make that happen. Can you remind us how much of the shares are owned by management and the board?
I think it's around about 5% off the top of my head.
Yeah,
it's on our website. It's in that region, yeah. Yeah.
I think we're sort of running up against our time now, but I think that's more or less. There's one or two other questions there we'll try to get around to and answer those separately. It just remains for me really to, on behalf of myself and Chris and Lisa, who is sitting in the background there, making sure that we behave, to thank you very much for your time this morning and for taking interest in SmartSpace. Thank you.
Frank, Christian, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of SmartSpace Software PLC, we'd like to thank you for attending today's presentation. Good afternoon to you.